All right. Our Chapter 7 of International Corporate Finance will cover international arbitrage and interest rate parity, IRP. So, what does this mean? And this chapter will basically cover conditions that result in various forms of international arbitrage and the realignment that will occur in response. Next, we will try to understand what is this thing called the interest rate parity. And then we will also try to understand what forward rate premiums across maturities and over time. So all this will be relating to for exchange rate. Okay, exchange rate. Okay, so what is the meaning of international arbitrage? When you see the word arbitrage, what does it mean? When you see the word arbitrage in finance, it usually means riskless profit. That means you can make a profit without taking any risk. So, as all investors in the world, their goal will always be finding arbitrage. Finding an arbitrage is like finding a gold mine. You can just go in and dig as much gold as you want. This is metaphorically speaking. That means in the finance world, when there is a way to make money but not taking any risk, that is a gold mine. All right. So, uh, so how does international arbitrage takes place, for that matter, and what will happen if there is arbitrage? So, in more realistically, when there is arbitrage, the price will usually realign. Means the gold mine will not be there for long. It is not there forever for you to dig a gold, and the gold is not unlimited. So arbitrage may happen, but it will not be for long and it will not be significant. All right. So what kind of forms of arbitrage that might take place? You will notice there will be locational arbitrage, triangular arbitrage, and covered interest arbitrage. So we'll see what this means. So what is a locational arbitrage basically? So the definition is when you buy currency at one location where it is cheap and you sell it at another location where it is more expensive. Okay, so just by buying and selling, you benefit from locational arbitrage. All right, so any gains from locational arbitrage are based on the amount of money used and the size of discrepancy. Realignment due to locational arbitrage usually will drive the price to adjust so that the arbitrage disappears. Okay, I hope you understand this page. What it simply means is, okay, for example, for those of you, I think most of you live in Kajang, right? Most of you live in Kajang. Okay, let's say Penang is famous for laksa. Okay, and all of you love to eat Penang laksa. And the thing is, Penang laksa, original Penang laksa, is not available in Kajang. Alright, so what do? I tell all of you that I travel to Penang every day. Let's say my office is in Penang. So I travel to Penang every day. Then I ask you every day, do you want Penang laksa Then all of you say, yes, you want. So 5 packs or 10 packs of Penang Laksa. So since we are friends, then I just round up the figure. I say 1 pack of Penang Laksa is 10 ringgit. Then all of you say, oh, okay, it's very cheap. Okay, it's very cheap. So this is just my side business. So I will travel to Penang just to buy the laksa and then come back and pass it to you for 10 ringgit each. For all you know, 1 pack of laksa is only 5 ringgit. So I charge you additional 5 ringgit for what I would say as for the profit. So I make money from you. Okay, and this kind of profit, if it involves zero risk, that means I can do it every day without effort, and then maybe I don't even have to go Penang. Now I get someone to go for me, go to Penang, do my job, buy the laksa, come back and deliver to you everything. My assistant will do. I never do anything. So there is zero risk. If there is zero risk and I make profit out of that, then it becomes an arbitrage. Then I'm very happy because you are my gold mine. You clear? Until one day, maybe Yuan Hao, you discover that the laksa is only 5 ringgit. And Yuan Hao also discovered that he can do the same. He can actually go to Penang every day and also buy back the laksa. And now he thinks that even if he sell it to you for 9 ringgit, he will make money. So Yuan Hao starts to undercut me, starts to take over what I do and offer at a lower, cheaper price and go bigger. So he will not only target you, he will target all his friends, family members, and Kajang people. So he will go to Penang, pack all this laksa, come back and sell for 9 ringgit instead of 10. Right? So he's trying to beat my business by selling the same thing at a cheaper price because he know that he will still make money. All right. So, and that happens, then other people start to realize. Probably Sanjita will start to realize, oh, why is Yuan Hao doing this? And Sanjita do some investigation, found out that the same thing. Oh, laksa is only 5 ringgit. All right. Or she found out that, oh, she also can cook the same laksa for the same taste and tell people they are from Penang. Right. So Sanjita will start to cook laksa. And instead of selling at 9, she will start to sell at 6 ringgit. And she still make money. So you notice that how when there is arbitrage, it is like an open gold mine. Everyone will look at it, everyone will see it, and everyone will try to take advantage of it as well. Until the point where it is no longer profitable to do so. So you see Sanjita is selling at 6 ringgit. So the next person will come in and sell at 550 and then it will go down to a rate where it is no longer profitable. And that is when arbitrage diminishes. Alright, so arbitrage may exist, but it may not exist for a long time. Alright. Okay, so back to a more appropriate example, which is the example of locational currency arbitrage. So if you look at this, one kind of arbitrage you can see is Akron Bank and Zin Bank. Okay, between these two banks also sell the same thing, British pound. All right, these two banks sells the same thing, British pound, but the pricing is different. So usually when the pricing is different, people will try to make money out of it. All right, people will try to make money out of it. So how? So you can see Akron Bank, if you want to buy British pound from them, you look at their ask price, $1.61. All right, and if you look at the ask price of Zinc Bank, is $1.62. So if you want to buy British pound, which one should you go to? You should go to Akron Bank because they sell it cheaper. Right? They sell the British pound at a cheaper price. And even you buy from Akron Bank, there will be no loss because if you buy and you don't want it anymore, you can go to Zin Bank and sell it back at 161. So if you buy at 161 and you don't want, you sell at 161, there is actually no loss. All right, no loss. Of course, you don't buy from Akron Bank and sell to Akron Bank. You don't do that because when you do that, you will lose 1 cent for every pound. So in order not to make any losses, you can buy from Akron Bank and sell to Zin Bank at zero gain, zero loss. All right, of course, you don't buy from Zin Bank because Zin Bank is selling at a higher price. And for all you know, these two banks are next to each other only. Okay, if they are next to each other or different location. All right, not too far. So you can compare and you can still buy and sell. Okay, at zero risk, zero cost. So take a look at a more appropriate locational arbitrage. Okay. For the example to work, let's look at North Bank and South Bank. These two banks that sells New Zealand dollar. All right. So New Zealand dollar quote in what? In US dollar. Yeah. This is US dollar. So you can see again, bid ask, bid ask. So bid ask means how much will the bank sell or buy New Zealand currency from you. All right. So you can see always in order to discover an arbitrage, you first look at their ask price. Which one sell New Zealand dollar cheaper? Which one sell cheaper? You can see that this one, North Bank, sell cheaper at 64 cents for 1 New Zealand dollar. So if you want to buy, you buy from North Bank because they are cheaper than South Bank. Right, when you buy. So you buy here. Okay. This is the first action. If you buy, where to buy? Number 2, if you have New Zealand dollar, where will you sell your New Zealand dollar? If you have New Zealand dollar, you will sell at a bid price. Which one has a higher bid price, North Bank or South Bank? South Bank. Right? South Bank are willing to buy New Zealand dollar from you. That means you can sell it to them at 645 cents, 664.5 cents per New Zealand dollar. So if you want to sell, choose to sell here at South Bank. All right. And then once you know where you should buy, where you should sell, you compare the buy price and sell price. Right? The third step is you compare the buy price and sell price. So you compare North Bank buy and South Bank sell. So you see that If you buy for 64 cents, Southbank will be willing to buy from you for 64.5 cents. So you notice, oh, that is a possible arbitrage opportunity. So that is how people discover arbitrage. Sometimes by accident, sometimes by analyzing. In this case, I would say by accident. Because since I want to buy, I compare these two companies and I found. Alright, I found the arbitrage. And why would I say this is an arbitrage? It's because I can buy cheap and sell at a higher price. And I believe there is no cost and no risk involved. So just like that, I buy, sell, buy, sell, buy, sell. I can make a profit. So this is how it is summarized here, down here. With step 1 and step 2, they said, if you have US dollar, use the US dollar to buy New Zealand dollar at North Bank. Okay? Buy it here, step 1. And once you have bought this New Zealand dollar, take it to the South Bank and sell it to get back your US dollar. So what actually happened? In your case, you only need to take your US dollar, change to New Zealand dollar, okay, USD, change to NZD, and you come here. This is step 1. Step 2, you take your NZD, New Zealand dollar, change to USD. And just like that, you make a profit. Okay, it's a no-brainer. You don't even need to use your brain. You only need to change money from one place and then change back your money in another place and you make profit. So this is what is known as arbitrage. Will it happen? Yes. Will it be long? Will it last forever? No, it won't. Why? Because if you could keep doing that, South Bank will have what? It will have too much supply of US dollar. Right? They will have too much US dollar and probably they will reduce the price because they think that, oh, they don't need so much anymore. So they reduce the price so that when you do it some more, it is no longer profitable. So if they see you keep doing it every day, they just need to change the price and it is no longer profitable for you and they know that the problem is solved. If you keep doing that, right, example, if you go to a shop every day to buy the same thing, if you are the shop owner, don't you feel funny? Hey, why this guy every day come and buy so much? So you will do some investigation and found that, oh, your item is priced incorrectly. Probably you are selling things for too cheap or you are buying things for too high price. Alright, so it will not last and arbitrage opportunity will disappear. So this is just a simple locational arbitrage between one location and another. Moving on to triangular arbitrage. So triangular arbitrage is not as straightforward as locational arbitrage. Okay, this is because locational arbitrage is rare. It rarely happens. Okay, and even if it happens, it will be discovered very quickly. All right, just like like if you go online, right? If you see that hey, one seller is selling things very cheap, okay? So what you can do is you can keep buying and then you sell to your friends. And because your friend don't know about it. But then turns out the seller has displayed a wrong pricing. So once he discover, he will quickly change back to the correct price and you lose your arbitrage immediately. All right, you cannot make any riskless profit. So it might happen, but it might disappear also very quickly. So the next one that is also possible is known as the triangular arbitrage. So what is the triangular arbitrage? Triangular arbitrage is defined as currency transaction in spot market where you capitalize on discrepancies in cross exchange rate between two currencies. So this one relates to more than two currencies. It relates to three different currencies. All right. So transaction cost of using bid ask spread can actually reduce or eliminate gains from triangular arbitrage. And usually when there's triangular arbitrage, there will be realignment. That means it will not be for long also. All right, so let's see what it means. Let's see what it means. So it might happen, it might happen that there is three currencies, USD, British pound, and ringgit. Okay, three currencies. That's why they call it triangular arbitrage. So instead of just buy and sell, now it's a little bit more complicated, right? Because buy and sell locational is too easy to be found. This gold mine, very easy to be found, so it will not happen. The second one is triangular arbitrage, how it happened. So you use US dollar to exchange for pound at $1.60 per pound. So you will need 10,000 USD in order to get 6,250. All right. So you at first you take USD, convert to pound. First step. And then once you have pound, you use pound, convert to Malaysian ringgit. All right. And this is because the conversion rate is 1 pound for 8 ringgit and 10 cents. So you get 6,250 pounds you get to exchange for 50,625 ringgit. All right. And the final step is you use the quote of US dollar and ringgit where 20 cent USD is equals to 1 ringgit. So when you have 50,000 ringgit, divide by the amount or times with 0.2, you will be getting, you convert all your ringgit back to USD, okay, MYR, convert to USD is your final step, step 3. And with that 50,000, you get 10,125. So imagine you start this thing with 10,000 and you convert 2 times and you get back 10,125. So again, this shows that you make profit without any effort and without any risk. Can you see that? Just by taking US dollar, go to the market, buy pound, take pound, buy ringgit, take ringgit, convert to USD. Just like that, you make profit. You never even move a finger, you make profit. So this is what is known as an arbitrage, a gold mine. And instead of as simple as locational buy and sell, this one involves three currencies. So there must be a discrepancy between the three currency in order for this to happen. So this one also needs some little bit of analysis in order to identify this loophole. And again, once you found this and you keep doing this, the demand and supply will eventually change the price, and when the price change, your opportunity of arbitrage will be lost again. Okay, so it might happen, this thing, it might happen, but it will not last long. Okay, it will not last long. Very fast, it will be gone. All right, so it's like just a gold mine. The moment you discover the gold mine, you try to make more money for it, no more. That means the price has already changed in order to uh, solve this arbitrage, so that there is no longer arbitrage. All right. So an open gold mine, or anything that drops in the on the floor, very quickly ends will come. All right. So how did this happen? How did this happen? So here in the case, this is how it works. Yeah. So this is in reality. When you see this, how can you see opportunity? It's very hard to see, right? It's very hard to see, because what it means is basically there are just three exchange rate. One is pound and dollar, one is ringgit and dollar, the next is pound and ringgit. So there are three exchange rate here, but 160, yeah, okay, three exchange rate here, and in order to find the arbitrage, it will be more challenging. Plus, sorry, now instead of just, if you notice in the previous page, I show you that example. They are using 160, 810, and 20 cent. Okay, so what price is that? They are actually using the bid price only. Is it fair? No, it's not fair, because when you buy, it usually should be the higher price. When you sell, usually should be the lower price, because you cannot buy and sell at the same price. All right, so there is always a bid ask spread in order to prevent arbitrage or to prevent losses to the currency seller, currency exchange. So if now there exists a bid ask spread, so if you have US dollar here now, okay, the first step, US dollar exchange for pound. So US dollar buy pound, US dollar to buy pound. This one, right? US dollar to buy pound. Which one will you use? You will be using 161, not 160. Yeah, you have to buy at $1.61, because when you buy, usually you buy at a higher price. All right, and then with British pound, you buy ringgit. All right, with British pound, you buy ringgit. Here too. British pound, buy ringgit. So value of pound in ringgit. You want to buy ringgit? Which one is this? Convert to ringgit. Usually it is the cheaper one, I think. Yeah, cheaper one. Right? Cheaper. So you want to buy ringgit, you want to sell your pound to get ringgit. So if you want to sell your pound, usually the exchange, they will buy at a lower rate and they will sell at this rate. Okay, they will buy at 8.10 from you. So they will buy your pound at 8.10. Okay, this is the second step. The third step is once you have ringgit, you want to buy US dollar. Okay, ringgit to buy US dollar. But this value of ringgit in US dollar. But now here you are selling US dollar and selling ringgit to get US dollar. Alright? When you are selling ringgit to get US dollar, you sell at this price. Okay, so instead of using 160, 20 cent and 8.10, you are using 161, 20 cent and 8.10. So when there is this thing called the bid-ask spread, your first step, you will use 161 instead of 160. Okay, at a higher price. And then once that happens, you convert to ringgit and you get 50,310. And with the ringgit, you convert back to US dollar at 20 cent per ringgit. You get $10,062. So originally you have 10,000, and at the end of the arbitrage transaction you get $10,062. So you actually now make what? $62, just like that. Right? But if there is bid-ask spread, your profit of $62 is actually lower than your profit of 125. See that or not? Alright, so if there is only one rate, there is no bid, there is no ask. You only follow one rate, which is unrealistic, yeah, which is unrealistic. So you can see that you make $125. Theoretically, you can make $125 from arbitrage. But considering bid-ask spread, which is more realistic, you will make $62. Alright, still an arbitrage, but realistically rather than theoretically, you make less. Right, you make less. And in a more realistic or real life situation, there will also be some costs involved. Some costs. So it might further reduce your arbitrage, maybe to $20 or $30. And then your profit is actually very little from arbitrage. But again, this profit is with zero risk. So if there's zero risk, then even $1 I want. Right? So arbitrage is not about how much you make or how much risk you take. No, arbitrage is simply making profit by taking zero risk. Alright, as even if you got 10 cent profit, but you took zero risk, that is arbitrage. Alright, so here what it says the impact of triangular arbitrage. What you did here, what was the impact? So the first thing is when you use dollar to buy pound, your first step here. When you use dollar to buy pound. So you just buy and sell like nobody's business. But in actual fact, what happens when you use dollar to buy pound? Bank will start to increase the price of pound because he sees that, oh, now I have less pound. Okay, now I have less pound. I want to sell higher price because you bought a lot of pound from them already. Right? And then when you use pound to buy ringgit, what will happen? They will have the bank now will have a lot of pound. So they don't want pound anymore. So they will reduce the price of pound and probably increase the price of ringgit so that they want to buy less pound. Alright? And thirdly, when you use ringgit to buy US dollar, that particular bank will reduce the value of ringgit, the price of ringgit, because now they have less dollar, more ringgit. So they don't want ringgit, they reduce the price. So when all this impact happens at the same time, you will notice that your arbitrage will diminish. Means it's all demand and supply in play. Example, if you go to the supermarket and you see broccoli is very cheap. Okay, 1 ringgit one. Okay, 1 ringgit one broccoli, big one, very nice. So you buy 10. Okay, you buy 10 broccolis. You buy 10 broccolis for 10 ringgit. And then you go out to the wet market and you see that this person is selling broccoli for 1 ringgit and 20 cents. 20 cents more. So since you have so many broccoli and you think you overbought, you bought too many. So you go to this guy and ask him, oh, would you want to buy some of your broccoli? My broccoli lah. And the guy said, yes, he don't mind. He wants to buy. So you sell him your broccoli at how much? How much will he offer? Since he is selling at 120, he is willing to buy from you at 110, right? So you quietly feel happy because you bought it only for 1. Now you can sell at 110. So automatically from consumer, now you are becoming a supplier and you are making money from it. So, okay, you said, since you offer 110, you will sell all the broccoli to him. All right, so you make 10 cents each, zero risk. So the next day, you do the same thing. You go to a supermarket again to try to do the same thing. Buy at 1 ringgit, go to the market, sell to this guy at 110. So, but the next morning, you go to the market, something surprised you. You go to the supermarket, oh, the broccoli has increased in price because they said that there is too high demand. There are too many people buying. You also don't know why, because you say you only buy 10. But then the supermarket say, oh, everyone also buy 10, not just you. So they noticed that the price they set was too low. So they increased to 105. Okay, $1.05. So you think it's still fine. If you buy at $1.05, you bring it to the market, you can still sell at 110, right? Okay, so the first day, you buy at $1. Okay, and you sell at 110. Profit, just like that. Second day, you go to the supermarket, now the price has increased because too high demand. And then now you go to the market with all your broccolis, you try to sell to the same guy. The guy said, oh, sorry, there are still some broccoli since yesterday he cannot sell. So they are left over. So he will still buy from you the broccoli, but he cannot offer you 110 because, again, he has bought too many broccolis, cannot finish selling. So he now offers you the same 105 for your broccoli. So will you want to sell or not? Now you realize that whatever you bought and now you sell, you don't make any profit. So you can see that arbitrage, yes, and the next day arbitrage, no. So it is obvious that whatever you did in the day before has impacted whatever in the day after. So there is impact. Since you bought so much, the price has gone up, and since you sell so much, the price has gone down. So when the buy price increase, sell price drop, then arbitrage is gone. And now you lost your profit making opportunity already. So arbitrage does not last. That's what I'm trying to say. And they are now just applying it into the foreign exchange market. All right. Any questions so far? No question. All right.
So far,
Uh,
no.
10, 20. Oh, wait. Can we have a 15 minutes break? 10:30. We have time. 10:30 until 12, right? Yeah. Can we have a 15 minutes break? And then we'll continue after the break. All right. See you at 11:35. All right, welcome back. If you are back, just raise your hand. All right, thanks. Okay, let's move on from triangular arbitrage. The next one is known as the covered interest arbitrage. So what is the covered interest arbitrage? This one involves a little bit more on interest rate differential between two countries. Okay, and covering the risk of exchange rate with a forward contract. So example, you are a Malaysian and you found that Singapore is a neighboring country offer higher interest rate. So you are very attracted to invest in Singapore because they have higher interest rate, so you can earn higher interest. But you are afraid of one thing. You are afraid of exchange rate risk. You worry that after you earn the interest, you convert back to ringgit, uh, you will not make any gain or you will make losses. So in order to prevent any risk, you can cover that with a forward contract. All right. And in order for this arbitrage to take place, there must be a difference between the interest rates of the two countries. Okay, and the word covered is because you cover the exchange rate risk. And when this happens, usually this arbitrage, again, it will not last long because the market will realign itself and it may take a little time for this to be realigned. So compared to locational as well as triangular, this one takes a little bit more time to be discovered and the arbitrage to be gone. So it takes slightly longer time because a little bit more complicated lah. So anyhow, let's take a look how it happens. All right, let's take a look how it happens. This is UK. This is US. US, I would say maybe 2%. All right, so now you can see the interest rates for 90 days in the UK is 4% and US is 2%. So no matter where you are, UK interest rate will be more attractive. Okay, no matter where you are, even in Malaysia, Singapore, or US, UK will look even better, more attractive. So what you will do is, the example here given is you are the investor. Okay, you are the investor. So what you do is, let's say you have US dollar. Okay, you are a US investor. You take your US dollar because you know that the UK only accept pound and you want to benefit this 4% interest rate from UK, you need to deposit in pound. So the first step is to convert your US dollar into pound. All right, convert into pound. And then the second step is to take all your pound to invest in the British bank or any deposit so that you can earn 4%. Okay, so this is already a win because in US, it's only 2%. All right, so it is already a win for you. But there is one thing you fear. You worry that 90 days later, British pound will depreciate. And when it depreciates, whatever you earn might be a loss. So to prevent this from happening, on the same day you deposit, you lock in a forward rate to convert. Let's say 90 days later you will have 520,000 in your bank account because 500,000 earn 4% is 20,000. All right. So you will have 520,000 pounds in your bank in return, but you will need it 90 days later. So you lock in a forward rate to exchange 520, 520K to 832K US dollar today. You lock in today. All right. And 90 days later, once you have that money in the account, you automatically convert into US dollar and you get back your money. All right. This will be a more powerful arbitrage when investors don't have the money. What they do is they borrow in US dollar. Why do they borrow in US dollar? Because US dollar is cheap, 2% only interest rate. So you borrow for 2%, you invest and earn 4%, and you cover the exchange rate risk. In total, 4% minus 2%, you actually make a riskless profit of 2%. You get what I'm saying? Because you can borrow as much as you want and you can invest as much as you want. So if you can borrow 100 million, you will borrow 100 million. Right after all, the cost is only 2%. Whatever you earn in UK will be more than enough to cover for what you borrow. But there's only one condition. You need to lock on to the forward rate to make sure that in the future, when you convert back whatever earnings you make in UK in a foreign country, that you will get back enough to cover for your borrowing in US dollar. So whatever you earn, let's say you earn in UK 4%, and then what is your cost of borrowing in US? 2%. So you simply make 2% of arbitrage in 90 days without using your own money. Zero capital, zero risk, 2% return. And that is why it is known as an arbitrage, because you don't need any risk, you don't need any capital, and you make money. So this is like a zero capital business. You make money. And again, they said after this being said, it will not last long. All right, when people realize this, people will keep doing this. All right, so what is the comparison between the arbitrage effect? So arbitrage is also very dangerous for the seller, because if you take advantage of the arbitrage, you will be the person who profit. The losses will be borne by the banks. Banks will take the losses. So this is a threat to local banks. So when banks want to set the price of their currency, they have to do enough research to make sure that you don't profit for it. And the triangular arbitrage involves the three different currency also is there so that it ensures that cross exchange rate are properly set. That means there is no discrepancy. The moment people find any discrepancy, they will surely take advantage of it. It is just like seeing a gold mine or a house with open door, a lot of money. Will you go in? Of course, you will go in and take, right? So they all have to make sure that their doors and everything are properly locked, right, to prevent any possible arbitrage. And the covered arbitrage again ensures that forward exchange rates are properly set, because any discrepancies will trigger arbitrage. All right, so arbitrage is a good thing in some way in order to ensure that the foreign exchange market is working efficiently. Okay. So this is the three strategies of how to how to capitalize on the discrepancy. So locational will be discrepancy between two locations. Triangular between three locations or three currencies, okay, or what they call as cross exchange rate. The interest rate covered interest arbitrage will depend on the discrepancies between forward rate and the interest rate differential. All right. So therefore, we will further go into the covered interest arbitrage. Why? Because this is a little bit more complicated. So again, how do you uh, reach? How do you do a covered interest arbitrage strategy? One, convert. Back, convert. Two, invest. Three, forward contract. Right, so these three is important. And why do you convert and invest? Because you found that the interest rate in another currency is higher. Convert and invest. To invest in a currency with higher interest rate. And then the next one is forward rate. So the premium. When you go into forward rate, there should be a premium. But if there is no premium, then you can just capitalize on the higher interest rate without taking any risk and you gain. So in the case where there is a possible interest rate arbitrage between different countries, then there will be a forward premium. That means when you want to convert into the future exchange rate, there will be a premium. Okay, the premium will ensure that whatever gains that you make, let's say the difference is between 4% one country and 2% one country. So if everyone do this, there will be a 2% profit arbitrage to anyone who does this. But this profit must be funded by someone who making losses. Profit don't just come like that. There will be someone who is making losses. So the countries who's making losses is actually very unfortunate. So in order to prevent this from happening, the country will impose a forward premium. So that whatever you gain here, positive 2%, will be offset by the forward premium of 2%, negative 2%. So if you make a gain 2% in interest, you make a loss 2% in the forward rate, then you actually make 0%. So now if there is a forward premium, therefore whatever differential between interest rate of two currency will not be attractive anymore. All right. So what is the premium that should be? It will be based on the 1 plus home interest rate divided by 1 plus foreign interest rate minus 1. Then therefore you get the premium. Okay. All right. So alternatively, premium can also be calculated by forward minus spot divided by spot, or summarized by an easy calculation, home minus foreign interest rate. So like what I said, if IH is 4% interest rate at home, okay, interest rate foreign is equals to 2%. So what is the potential arbitrage? 2%, right? So you can actually gain in H or home of 2%. So you can actually gain more in one country. When it is possible to gain more in one country, there exists a possibility of arbitrage. But again, now you see P is equals to or almost equals to IH minus IF, which is almost equals to 2%. So if there is a possibility of making arbitrage based on interest rate by 2%, the premium will also be 2% for the forward rate. So you may gain here, but you will lose here. And therefore, now it is fair. No arbitrage. So this is the line where it explains how arbitrage takes place. So the IRP line will show that there is a interest rate parity. Interest rate parity means the forward premium is enough to offset the gains of the differential in interest rate. Okay, so whatever that's on the line means you do not get any additional arbitrage, anything that's on the line. If it's Z, X, or Y, then it is possible to make an arbitrage. Okay, why does this happen? So we just take a look. At any point of AB and CD, it is an IRP. IRP is interest rate parity. Means whatever you earn, you will not get benefit because of the forward premium or forward discount. However, whatever that is below the IRP line, below X and Y. Can you see that? Can you see Y means what? Forward premium is 4%, but the interest rate differential is only 2%. See that? It's different. And here is 3% and 1%. So it's different. Okay, you can see that it is different. All right. So what does it mean? It simply means that investors can engage in covered interest arbitrage, earn a higher return by investing in foreign currency. All right. However, in point Z, above the IRP line, so if it's above the IRP line, there is a forward discount of 3%, but the foreign interest rate, IH minus IF, is -1. Right. So in this case, US investor will achieve lower return on foreign investment than domestic one. All right. Point Z. All right. HIF. Yeah. See that? IH minus IF. If IH is IUS, US. If let's say it is 2%, IF is a foreign country, is 3%. So if IH minus IF is equals to -1%. Right. So that case here, you will see that there is -1 return. Means what? It means that if you invest in foreign currency, you will earn 1% extra. 1% extra. But there will be a forward discount that makes you lose 3%. Okay, so you will gain 1%. RF, you will gain 1% because you will get higher interest in foreign market. But in terms of premium or forward rate, you will lose 3%. That is point Z. Okay, so in total, you will lose 2%. So it is not good. All right. But whatever under the line, if you see Y means what? Y is IH minus IF is 2%, means IH probably is 4%. IF equals to maybe 2%. Okay, so you get IH minus IF 2%. But the forward premium is 4%. Okay, premium 4%. So what it means, investor can engage in covered interest arbitrage and gain a higher return by investing in foreign currency after considering foreign interest rate and forward premium or discount. Means you can see that home 4%, foreign 2%. So by right, you say that, oh, home higher interest, so we invest in home. No, this is because if you invest in home, you will gain 4%, but you will lose 4% in terms of the premium. But if you invest in foreign, you earn 2%, and there is a forward premium of 2%. In total, you will earn 6%. All right. So there will be a higher gain if you invest in a foreign market. So you don't just earn from interest. In this case, you also earn from the forward premium. Forward premium, what is it? Forward premium is the expected appreciation of the future exchange rate. Okay, expected. So they expect the value will increase, so there is a premium charge. Okay, so moving on from the graph is to identify and to test how to know whether interest rate parity exists. All right, so here they say that they summarize. I would say summary you can see here. Summary you can see here. Whatever that's on the line, there is no interest arbitrage possible. But whatever that is above is possible. Whatever that is below is also possible, where to make an interest arbitrage. But by who? The bottom one is by investors in the home country. The top one is potential arbitrage by foreign investor. All right. So what else may affect interest rate parity and whether all these things that we have considered, is it enough? So interest rate parity does not imply that investors from different countries will earn same return. That's one. Does interest rate parity hold? For this, you have to do research and to explain whether in real case scenario, real life, does interest rate parity hold? Or is there arbitrage? Okay? If it holds, means there is no arbitrage. All right, so things to consider when you want to assess interest rate parity, not just interest rate and forward premium, but you have to also take into consideration transaction costs, because when you convert from one currency to another, there will be a transaction cost. Like if you want to convert ringgit to pound, all right, you want to convert ringgit into pound, that one thing, there will be a bid ask spread. That means if you buy, you will pay ask price, but when you convert back, you will sell the bid price. So usually you will lose there. Alternatively, if there is no bid ask price, when you convert at the spot rate, you need to pay a transaction fee, maybe about 100 ringgit. Every time you convert, you need to pay 100 ringgit. That will be transaction cost, but previously we did not consider this. We didn't talk about this at all because the amount that we use is very huge. So small transaction cost may not affect much. Second thing is the political risk, where foreign country may suddenly have crisis and restrict any exchange rate of local currency. And then there will probably be tax law, right? Because some countries have very strict tax law where if you make interest gains in the country, you need to pay tax before converting back. So your interest also have to consider tax. Okay, when we didn't even talk about this also. But we are just based on a simplistic model to explain how interest rate differential between home and foreign country, taking into consideration exchange rate risk, how it might be possible for investors to make a zero risk return, which is known as the arbitrage. All right. So forward premium may change. It will not be static. It will change across maturities. That means the longer time you take, previous example, we use only 90 days, right? So if you want to lock into a forward rate that is longer than 90 days, most likely the forward premium will be higher. And if you lock into forward rate today and also forward rate tomorrow, the premium might be different over time. Okay, today and tomorrow might be different pricing. And the changes of forward rate can be affected by all factors, okay, including those that affect the spot rate, including inflation and interest rate. So forward rate are not only determined by maturities and that they change over time. Their change can be explained by many factors. All right, so if you can see here, this is the example of interest rate for various time of maturity plus the forward rate. And this is the relationship between interest rate and forward rate premiums. All right, so you can see that here, when US interest rate and Euro interest rate differ, the moment it differ, you can see that the forward premium increase, right? When US interest rate is higher than Euro, what will happen? US interest will look more attractive, so people will go there. So therefore, there will be a forward premium. And when Euro interest rate is higher, you can see Euro interest rate is higher. So now Euro interest will look more attractive. When Euro interest rate is looking more attractive, what will happen? That means you know that people is going to invest in Europe. So what happens is the forward rate of Euro is no longer premium, is now discount. Okay, so you see, the moment it differs, the premium will show of the forward rate. So this is to reflect that when there is interest rate differ, there will be movement. There will be movement of money into Europe. And if the US interest rate increase higher than Europe, we anticipate that money will move to US. So based on these anticipations, the forward rate will also adjust. Okay, the forward rate will adjust. So this one shows the differences between the two currency. Okay, this is dollar minus euro, interest rate of dollar minus euro. So you can see that here is when the US interest rate is higher. Here is when the US interest rate is lower. And this one can automatically be reflected by the forward rate premium. Okay, so if you make money in euro, you will lose money in the forward exchange. If you make money in US, you will lose money in the forward rate premium. Okay, so whenever there is a higher interest rate, it is not as simple as moving your money there, make gains and come back. No, your gains will definitely be wiped out by the forward rate. This is in order to ensure that there is no arbitrage. All right, so the rest is the summary of what we have covered today, which includes locational, triangular, covered interest arbitrage. And in conclusion, I would say that arbitrage is there because there are opportunities and sometimes discrepancies that enable people to make riskless return. But however, these possibilities will not be around for long because the market will adjust itself. uh, in terms of covered interest arbitrage, it will be adjusted by the forward premium or forward discount. As for locational and triangular arbitrage, the bid-ask spread will change to reflect the demand and supply of uh, currencies. All right, so in the last thing that we reveal in this chapter would be the interest rate parity, whereby is a theory that states that the size of forward premium should be equal to the interest rate differential between two countries of concern. When IRP exists, covered interest arbitrage is not feasible because any interest rate advantage in foreign country will be offset by discount forward rate. And thus, the act of covered interest arbitrage will generate a return that is no higher than what would be generated by a domestic investment. So, easily here said, when maybe your parents one day tell you that, oh, Singapore offer higher interest rate than Malaysia. Let's put all our money in Singapore. What will be your response? Your response is based on the theory of interest rate parity. So you can advise your parents that actually, although Singapore interest rate is higher than Malaysian interest rate right now, but after investing in Singapore and if we want to convert it back to ringgit, there will be no additional gain or no difference because of the possible uh, discount in forward rate. You get what I mean? So investing in Singapore and Malaysia makes no difference now because if interest rate parity stands, if you gain higher in Singapore, the interest rate is higher. But in the future, when you convert back to ringgit, you will still get back the same amount due to the forward rate premium, forward premium or discount. All right, so therefore, it means that interest rate in every country should be the same at all times. All right, although there is a difference, it will be offset by any forward premium or discount. All right. Oh, exit time. I'm sorry. Sorry, I exceeded time. Everyone okay? Any question?